Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers, and today I'm going to talk about rebalancing. I've been telling my customers in this volatile market, you might want to take a look at your 401k and things and see about rebalancing. We rebalance all of our portfolios here automatically for you guys. Not automatically, but we do it for you here. We manage our own portfolios, so we have complete control over all of your investments if you happen to be one of our customers. But the 401k I can advise on, and I do help every customer with it, but I can't press the buttons, right? So I got to bring it to your attention when it's time to rebalance. And I've been doing that with our customers, and I give them some specific criteria on how to do that. As for the rest of you, it occurs to me through questions from actually my best friend. He texted me. He said, what does that mean, rebalancing? Help me out. And I'm like, oh my gosh, how embarrassing. I got to help you. So what I'm going to do is go over it briefly in sort of general terms, and then I'm going to show you some of the data to show you why it's so important that you look at rebalancing right now. So let's take the most simple example that I can come up with off the top of my head. Let's say you have a 60-40 portfolio of stocks and bonds, and for the sake of easy math, I'm going to pretend that you have $10,000 to invest, right? And so what this means is you've got stocks in here of $6,000, 60% of $10,000, and let's say you've chosen bonds and you have $4,000 in that. Just a really simple explanation. I don't mean to get into like investments or anything here, but this is your breakdown of stocks and bonds. Now, what's happened recently is the stock market has been extremely volatile to the downside, and so what you might have noticed is the value of your stock position in your 401k or whatever has gone down. So I'll make it simple and pretend that we lost 10% there. That's $5,400, right? So the value of your stocks is now $5,400, and bonds are inversely correlated to the market for the most part. It's almost a perfect correlation. So we'll say that those, it's not a perfect correlation. In terms of direction, it's a perfect correlation. In percentages, it can be a lot more. But for the sake of being really simple today, I'm going to just assume that this went up 10%. All right, so you lost 10% on your stocks. You've seen what's going on in the markets, and let's say your bonds only went up 10%. So what's happened here? You wanted to be 60-40, and 6,000 plus 4,000 is 10,000, so that's a even 60-40 split. You've determined that that's the speed that you want your portfolio to go, but what's happened is the markets have moved now, and all of a sudden you've got 9,800. You're taking a bit of a loss. That's okay, temporary loss there. But what's happened now is your allocation is off. You are no longer 60-40, and you didn't do anything, right? All you did was sit back and be a good investor and not panic during the downturn. So if we take 5,400 into 9,800, it's got to be about 55%, I would assume, right? And if we take 4,400 into 9,800, I'm going to assume that's 45%. Me if I'm wrong on that one. And so what's happened is you went from being a 60-40 investor to a 55-45 investor, and you think, well, that's not that big of a deal. What does that matter? It matters a lot because you're taking less risk. Your growth overall has been reduced. Bonds are not known as a growth type investment, so what's happened here is you've slowed down your portfolio through no action of your own, and now when the markets recover at some point, you have less stocks. You have less of a stock position than you did. Now, at some point, it will rebalance itself if markets do recover, but what if they don't recover and they slowly trend higher? All of a sudden, you're missing out on that little bit of growth, and if someone's not rebalancing for you or you're not doing it, well, you might want to ask them to do that or get in there and do it. So now, that's the brief sort of simple explanation. Let me go through some of the data here and show you what is going on. So looking at the charts here, this is the S&P 500. So we're going to say that this is the stock portion of your investment. So let's just pretend that this is the stock portion here. And let's pretend that this is the bond portion, just to show you the correlation. So I'm using the TLT or the 20-year bond to kind of show the inverse correlation, right? Stock market falls, bonds tend to move higher. Now, bonds have moved a lot sharply higher, They've moved sharply higher relative to the market, but you can see what I'm talking about. If you look through the performance of stocks versus bonds, they are inverse, meaning when markets go down, bonds go up. When bonds go down, markets go up. You can kind of see that inverse correlation, especially in moments of panic, right, or volatility in the market. So what we did here is I wanted to use a quick example. I'm going to just go ahead and show you. Let's plot a 60. So if I take this here, 60-40 overall portfolio right there. There we go. Let's pretend that this is where you started. I'm going to zoom out here a little bit because I want to actually show right here the last time the markets did pull back. So when more than 10%. In fact, the 20% during the October highs all the way down to the end of the year. It was a Merry Christmas. We set a new it was a lot of fun. So we fell 20%. Now your portfolio at this has become something dramatically different than 60-40. Well, watch what happens. Let's say it turned into a 40-60 portfolio, right? All of a sudden, the orange line, let's pretend, is 40-60. So in this example behind me, you went from having 60-40, the markets fell so much that now you're only 40% stocks and 60% bonds. Look at what happened on the next recovery. Your 60-40, or your purple portfolio, ended up outpacing your 40-60 portfolio, or meaning your 40% only stocks. And that makes sense, right? Because stocks are more, they're more growth-oriented compared to bonds. I mean, naturally, they move slower. So what we don't want to happen is a moment where the markets sell off like this and you do not rebalance. A 20% drop in the market is a respectable reason to go rebalance your portfolio. The pros do it. All the mutual funds do it. So you should be in there doing it as well, because when we do recover, you want to recover with the 60-40 speed. To make it overly simplified here, you don't want to recover 60 speed. You want to recover with the same speed that you were trying to get the whole time. And so that is the reason why you want to get in there and rebalance your portfolio if you feel like its move has taken you outside of the mix. I keep hearing the worst advice on TV where people say you should not look at your 401k, just turn away, everything will be fine. Okay, but that's horrible advice. You should be looking. Maybe you don't want to look at the balance. I understand if you don't want to look at the balance right now. It's a little crazy. But you should be looking at your target allocation versus your current allocation. And if you notice there's a serious difference there, find the rebalance button and just hit it real quick. It'll ask you if you're sure. Hit yes and move on. But you definitely want to look at doing that if things get a little out of control. All right. I hope this helped you. This is the type of help and advice we give our customers all the time here. Not just a financial advisor. We are a financial educator as well. We like to teach our customers. They do it every week in a class and every weekend in an email, in addition to being able to contact us anytime you have questions. Hope that helps you guys. If it did, hit the thumbs up button. And Joe, this one's for you, buddy. My best friend didn't know what rebalancing was, so helping him out there. Enjoy your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.